A lot of business owners that I'm speaking to at the moment are looking at company restructures or share-for-share exchanges as part of a standard part of their exit planning. For years, these have been seen as relatively safe, tax-neutral events. The ground has completely shifted. I'm Abbas, a chartered accountant and a chartered tax advisor. I help business owners navigate complex tax transitions, and right now, the rules around corporate reorganisations have undergone their biggest change in years. If you're assuming that your next restructure is just a rollover, you could be walking into a dry tax charge. So let's look at how things used to work. For a long time, we relied on a two-part test under Section 137 of the Taxation of Capital Gains Act 1992 to get tax-neutral treatment, meaning that your gains just roll over into the new shares. You had to show the exchange was for bona fide commercial reasons, and it wasn't a part of a scheme where the main purpose was tax avoidance. So in practice, as long as you had a decent commercial reason, like preparing for a sale or simplifying a group, or reorganising to get better borrowing terms, HMRC was generally satisfied. But as of November 2025, that commercial reasons limit has actually been dropped from the legislation. This is a shift that a lot of people are going to miss. HMRC has moved the goalposts entirely. They've replaced the old test with a much wider, much more aggressive main purpose test that looks specifically at arrangements. The new rules introduced in the autumn budget of 2025 target cases where any part of the arrangement has a main purpose of securing a tax advantage. So what this means in reality is that even if your overall transaction is 100% commercial, say you're merging with a competitor, if HMRC thinks that you've inserted a specific step or a particular class of shares just to reduce a tax bill, they can now strip away the relief from that specific part. It's no longer an all or nothing game. You have the power to make just and reasonable adjustments, which sounds fair in theory, but in practice, it gives them a massive amount of discretion to pick apart your structure. Now, another major protection that has quietly disappeared is the 5% de minimis rule. So previously, if you held less than 5% of the shares in a company, you were generally protected from these anti-avoidance challenges, and you could just take comfort being a minority shareholder in whatever the majority shareholders were doing with their planning. Now that's gone. Every single shareholder, regardless of how small their stake is, can be caught by these rules if the tax advantage test is met in HMRC's eyes. We're seeing this aggressive stance reflected in recent court cases too. Look at Moran versus HMRC decision from 2025. While that case had to do with transfer of assets abroad regime, the principle that the tribunal used is exactly what we're seeing here. If there is even one more than an incidental purpose of avoiding tax, the entire motive defense can collapse. HMRC is winning these cases because taxpayers can't often provide the level of evidence that is needed to prove that tax wasn't a driver. So if you're planning a restructure in 2026, the old way of doing things, relying on a general commercial narrative, is over. You need to be much more surgical. First, statutory clearance is now a non-negotiable. Don't just rely on your advisor saying it should be fine. You absolutely need that Section 138 clearance from HMRC before you move. And when you apply, you have to be incredibly transparent about why every single step in the transaction exists. If HMRC identifies a tax-motivated sub-arrangement that you didn't highlight, your clearance could be void. Secondly, the paper trail has to be bulletproof. Talking about board minutes, correspondence, internal meetings that reflect the commercial logic at the time and that the main purpose is not to avoid tax. You can't reconstruct a commercial narrative after HMRC has started an inquiry, say 3 years down the line. The point is, HMRC is no longer looking at the big picture of your business deal like it used to be under the old rules. They are now looking at the fine print of how you got there. If they see a route that was chosen specifically to access a relief, like business asset disclosure relief or the substantial shareholding exemption, and that route wasn't the only way to achieve your commercial goal, you could be in their crosshairs and they could look to deny the relief. This is high stakes territory. A mistake here doesn't just mean a delay, it means a dry tax charge. A massive tax bill on a gain you haven't even realized in cash yet. If you're in the middle of an exit or a restructure and you haven't reviewed your position against these new changes, you need to do it right now. If you found this video helpful and you want to stay ahead of the UK tax landscape, make sure you like the video and subscribe to the channel, and I'll see you in the next video.